Hello, everyone. I hope you're doing well today. Welcome to Canadian Finance Truths, a channel where we really kind of break down and talk about various financial topics, everything from just generic personal finance all the way up to more complicating topics such as the infinite banking concept, which is what we're going to be covering today, specifically the infinite banking worst case scenarios. Now, just an FYI, I'm not an insurance advisor. I don't get paid in any way, shape, or form to endorse or sell the infinite banking concept. I just think it's a really neat way of managing finances. Now, one thing that I'm going to cover in another video is, is infinite banking for everyone? I'll say yes and no to that, and I'll kind of go on more in future episodes. But today, what I want to cover is really the worst case scenarios in the infinite banking concept. Now, these are, with all my videos, I think of a topic and then I just go and do it. I don't pre-plan these. I don't script these videos out. And so if you can think of another worst case scenario that you are not sure about, let me know. So the ones that I've kind of looked at is that if you need to cancel your policy within a 5 to 7 year window, if you can no longer afford the premium payments, which could also mean that you have to cancel, these may be one in the same, that the insurance company outright fails, and that dividends stop being issued. So let's kind of break these down every step of the way. So what I've done here is I've actually gone through and I went and illustrated um, a policy. Now, what I said is that the premium policies are going to be $10,000 per year. Per year. Now, for this example, the age of the individual, all that type of stuff doesn't really matter. What does matter is, okay, well, what happens based on these projections? What happens if um, you need to cancel? Now, one thing I just want to cover here really, really quick, you'll see that there's the guaranteed column and then there's the non-guaranteed column. One of the biggest criticisms is, okay, well, it says non-guaranteed by nature, so you can't bank on these. So these are non-guaranteed based upon the current dividend scale. So assuming that the dividend scale remains the same, these dividends will get issued the way that it's supposed to. And if the dividend scale decreases, well, then these decrease, and they really don't decrease as much as you would think they would. The guaranteed values are if there is no dividends issued in any way, shape, or form, which we know just historically hasn't happened, but we'll talk about that in a second, right? So here's the thing, right? If you need to cancel, say, within the first 5-7 years, and you'll notice I've set this policy up a little differently, so we'll talk about that in a second. But in this policy, at $10,000 a year, at the year 5 mark, you are negative roughly $1,900, give or take, right? Approximately. So, one of the big things about the infinite banking concept is that the goal is that you're also going to be using this money along with whatever needs to be used. So, really, the only exposure or risk that you have is the deficiency between what you've deposited and what the number is. And this deficiency becomes lower and lower and lower as you progress down through the years. So in the first year, it's about $2,500. In the second year, it's about $3,500. And remember, $3,500, but you've put $20,000 in. So your risk is actually lower than in the first year, right? Then in the third year, it's about $2,900, give or take, and so on and so forth until basically it's $1,900. And then in the sixth year, in this example, but you'll notice we've done something funky here. You've basically broken even. So the thing is with whole life, and when you're looking at the infinite banking concept, you always have to understand risk. So the reason why people like the infinite banking concept is because it is consistent, it is predictable. If you are like me, you do not want to take on volatility. You don't want to take on unnecessary risk. You don't want to really be in the extreme unknowns. Okay, so you're looking at the infinite banking concept. So IBC, and then just regular, I guess, stock market. Right? You like the idea of the consistent, predictable returns, the ability to Know what your money's going to be at next year. Know that if you gain money, you don't decrease in money, the whole 9 yards, right? So when we look at this, okay, you know to a very, very certain degree what your risk is. Okay, because remember, once a dividend is guaranteed, or rather issued, it's issued, it can't be taken back. Okay. So when you're looking at this, if you need to cancel in the third year, your risk is 2,800 and what would it be? $26. That is how much it would cost you to cancel, because when you cash value, when you surrender, that's the money you're going to get back. And there shouldn't be any tax implications until the amount of money that you've put in is exceeded by the cash value. So, long story short, when you look at you needing to cancel, it can happen. Don't get me wrong. But you know exactly what your risk profile is. Now, one thing that I will say is that you may need to cancel it. So, what would be some reasons that you needed to cancel it? So, say for example, if you're working a high-paying job, you could afford the 10 grand a year, and then all of a sudden you can no longer afford that. You can afford less. Well, the thing is your required annual premium is only $4,400. I say only loosely, of course. And so you may not be able to afford the 10 anymore, but you certainly may be able to afford the $4,400. And I'm going to cover this in another video. But when structured with a max funded payment in year one, even if for every other year past this point, you only put in the required premium, so the reduced premium, the performance relative to the money you put in is almost identical. In fact, if I recall correctly, the internal rate of return on a policy that's max funded for the entire life is like 4.15%. When you only max fund the first year, the internal rate of return is like 4.05% or something like that. Anyway, obviously these change based on age and all this type of stuff, but the difference is very, very minimal, which means that you can actually just say, okay, I can't afford the 10, but I can afford the $4,400. If your problem's a short-term issue, remember that your premium that is required to be paid, if you don't have the money, well, you've got $7,500 in cash value, assuming you haven't used it. So you can leverage your own policy to pay its own premium if you know it's going to be a temporary issue. Now, of course, I wouldn't recommend that just to do it, of course, right? But it is something worth noting that you certainly can indeed do, right? So, long story short, what I really want to get really my point across is that your total risk is known right from the get-go. You know exactly how much is at risk. Okay. You cannot say the same for the stock market. The stock market, the risks are not known. We have a pretty good idea. I mean, they've been tracking the stock market for a whole long time, but it's still not known, right? And another thing too is that, like, if you go into this, and I'm not saying that every single time you'll be able to do this, but if you go into this only knowing that you can are just going to cancel after the first year, I wouldn't do it, right? I think everyone would agree. But if you get to say year 4, right, and your difference, and I'll actually calculate the exact amount, 40,000. So you're down 21, 22. Well, that represents a loss of approximately 5.3%, which by any stretch is a very conservative loss for something that you can't afford anymore. And ultimately, you get this cash back, right? So for whatever you couldn't afford it for, you get it back, right? The longer and the more you are in the policy, the less risky it becomes, not just from a total risk perspective in the sense of the dollars, but you have more options that are available to you, whether it is a policy loan paying the premium, whether it is surrendering some of the insurance, and I'll talk about that in a little bit to pay everything off. Anyway, you'll see that it's not as risky as a lot of people would think it is. Okay, and will claim it is, because they claim that there's these big, massive fees up front. But as you go down the list here, you'll see that things go up. So, okay, so we've kind of covered this one. If you need to cancel within 5 to 7 years, and also I'm just going to throw this out here, right? Well, let's go to the next one. You can't afford the premium payments. So, not being able to afford the premium payments, we've kind of already talked about this as it relates in years 1 to 5, right? You very well may have to cancel or pay reduced premiums or whatnot, right? But let's pretend, you're in year, let's say 6, okay? And you can't afford the premium payments anymore ever. Let's just say you've had a massive change in circumstance and you can no longer afford premium payments. Well, most insurance companies have what is known as an offset. So you'll notice that there's this column, premium paid by dividends, where the premiums here are completely paid by the dividends that are issued by the company itself. You'll notice your cash value continues to grow over time. However, you will notice that your death benefit does decrease. So, one option that you have, if you can't afford premium payments and you're past kind of year 5, 6, and 7, and it depends on how much dividends are issued, you can actually offset this. The insurance company will say, okay, we know that there's enough insurance in place that we can cancel out insurances to pay for the premiums. And we know that the dividends will eventually grow to a point where the dividends offset the premiums, and you should be good to go, right? So, long story short, if at a certain point in time, year 6, 7, 8, 9, 10, you can't pay any more, you can just offset this and your cash still grows, which is really, 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 really cool. And so ultimately, your return on investment for the amount of money that you put in accelerates more and more and more and more as time goes. You'll notice that the cash value grows at approximately, from year 6 to 10, it's approximately $2,000. And then it slowly creeps up to where it's about $2,500, give or take. And then you're getting into the $3,000 mark for the next 5 years. And so you'll notice it accelerates and accelerates and accelerates. Now, what's really interesting, and I didn't actually print this off, do a screenshot of it, is when your dividends exceed your premiums paid by the dividends, okay, the amount of death benefit that you have actually starts to increase again. So while you're seeing a steady decrease in your cash value, over time, this death benefit goes up. And so even if you do this, typically at the average age of death, your insured amount will typically be higher than what it was up here, even though you've now canceled a whole bunch of these paid up additions to pay for the policy. So that's really interesting. This big thing called offset. The reason why I bring this up is because, if you listen to the practitioners out there, they say it's got to be, for life. And they talk about how, you want to run all of your income through these policies and all this type of stuff, right? Like at a certain point in time, that's just not feasible anymore. And we'll talk about, do you put all your income in there and do you pay for life and all that type of stuff in other videos more in depth, but you don't have to, okay? Whole life is by far one of the most flexible products that I've ever seen, and really the only non-flexibility period, or the period that has the least amount of flexibility, is within the first 5 years. So I hope that makes sense. Honestly, you can go and offset it. You can cancel it. You can do whatever you want if you can't afford the premium payments anymore. But if you want to keep your bank, you just offset it and you're good to go. And worst case, even if you can't offset it, a lot of policies will last a very, 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 very long time, just doing policy loans against themselves. I wouldn't recommend that for long-term basis. You might hear my kid screaming in the background. I wouldn't recommend doing that for a long-term basis, but for a short-term issue, certainly, right? Okay, so, alrighty. So the next item we're going to cover is what happens if an insurance company fails. Now, this one I'm just going to talk about just you and I. I have not known a single Canadian insurance company that has failed, and I have only heard of a handful in the States that have failed. And by handful, like I can only distinctly remember one video that I watched that talked about a single insurance company fail that got bailed out by other insurance companies. Okay. insurance companies have to maintain so much money relative to the amount of death benefits that they have. All good insurance companies in Canada hold more than 100% of the amount of money they have to pay out in death benefits. Okay. Which really means that if the insurance company had to pay out every single death claim that they have, most insurance companies have the money in order to do so. Okay. Now we know that not everybody that the insurance company insures is going to die all at once. Okay. Let's just throw that out there. And if it were, there would be a much bigger issue in life than whether you still have your infinite banking policy. Right. Now, these numbers are tracked and there has to be so much maintained. So I'm not going to say it's not possible for the administration side or whatnot to start failing. I would highly suspect another insurance company would buy out the insurance company, especially as insurance companies are required by law to maintain so much money. And I believe it's 90%. So if an insurance company has death benefits of $1 million out there, they need to have $900,000 in cash. Most companies I know, again, are in excess of 100%. I could be wrong on the 90%. Comment below if you know any different, right? Anyway, I think the risk of an insurance company failing by nature of legislation, by nature of how they do business, okay, is next to impossible. All right. Yeah, nearly impossible. I'm not going to say never, but nearly impossible. Certainly more likely than a regular company that is basing their profitability off of largely unknowns, right? Okay, so next worst case scenario is that dividends stop being issued. Okay, so first, in order to understand why this isn't a big issue, we have to understand why and how insurance company dividends actually end up working. Now, I'm not an insurance salesman. I'm just basing this off of what I've seen. But essentially, dividends are based upon a smoothing effect, which means that you'll notice if you look at the stock market on an annual basis, right? If you've got, like say 2000 to 2021, okay? Now, I'm not claiming these to be accurate, okay? I'm just showing you kind of how this works, right? But essentially, say if you're, the stock market, this is zero. The 0% return. So, the stock market's going to have a, good return, better return, worse return, really worse return, did a little better, came back down, and it's going to be all over the map essentially, right? Got a little lazy there at the end, but you get the idea, okay? Now, this average historically, and we've talked about stock market returns in the past and how I don't believe the average investor can get them. But the average stock market return, historically has been like 8 to 10%. Let's just say that even in today's environment, long term, you can expect to receive 6.5 to 7%. Let's just say. Well, the insurance company is investing their money. Now, where are they investing their money? They're investing it in the market. They're investing it into private equities. They're investing it all over the place. Okay. And what they do is they receive a return on investment and they put it into a big account. All right. And in order to avoid the fluctuations of the stock market, what they'll do is they'll say, okay, we've generated a 10% return this year. We're going to withhold 4% of that. We're going to put it into the account for future years to smooth out any negative returns. We're going to issue out 6% as part of this year's basis, right? Now, that's not exactly how it works because remember, this is done over a lifetime, right? But really what ends up happening with your insurance is that your insurance is relatively smooth. Now, historically, it has been slightly declining, but so have market returns. So back in the day, you would expect to get 8 to 10%. Now it's 6.5 to 7%, right? So these are smoothed out. They're always going to be lower than stock market returns because of the fact that while the stock market may drop 20%, your insurance company is still paying a dividend of, say, 6.5% or whatever that might actually end up being, right? Now, 6.5% isn't what you get in the account. That's a topic for another video. But long story short, In order for an insurance company to stop issuing dividends completely, there would have to be a catastrophic failure of the stock market, because their dividends, by and large, are a byproduct of the market. A lot of it bonds as well. So market, bond market, real estate. They've got a ton of real estate. If you look in your own city, most likely a lot of the city downtown infrastructure, wherever you're at, is owned by insurance companies. So long story short, it would be a catastrophic failure in order for dividends to stop being issued, right? I just don't perceive this being a big issue, and I perceive it to be the same risk as the stock market crashing as a whole, which I just don't think is possible, or at least realistic. So everyone, these are what I perceive to be the worst case scenarios of infinite banking. The reality is, I think a lot of them can be overcome. The only one is if you need to cancel within the first, 5 to 7 years. That can be a little tricky, but everything else can be explained quite logically. If you agree with me, put a comment below. If you disagree with me, put a comment below. Like the video, please, and subscribe to the channel if you want to keep hearing content about infinite banking and just about finances in general. Alrighty, cheers.